Hi Abhyuday, welcome to today's An Hour with LawSikho. Today I have with me Abhyuday Agarwal, COO of IPeaters, and I am Ramanuj Mukherjee. I'm also from IPeaters, and we are going to talk about funding, money, how to get money for your business, and how to basically how to go, how does the whole thing work. So
Hi Ramanuj. Hi everyone. Thank you for logging in.
yeah. So Abhyuday, neither you nor I have really raised money ever for our companies, right? We did
That
have, we did talk to some of the people who are
we had
investing.
a few close shaves.
Sorry.
We had a few close shaves.
Yeah, we had a lot of interaction with investors, and in two ways. Like one is that we have done this as lawyers, where we have kind of uh, acted for or against investors, or for the entrepreneurs or against the entrepreneurs, and also we have ourselves couple of times spoken to investors about raising investment, although we decided against taking investment in our company.
So when we were at Trilegal, we were acting mostly for the investor side. And when we were doing work on our own, at that time we were acting a lot of times for companies directly.
Correct. So basically, we had like sort of like different perspectives to this whole funding business. And honestly speaking, seeing like both of you, you and I have seen tons and tons of our friends and others getting funded, invested, and we have seen the whole cycle of companies where investment came, they went on to raise more money or could not get any more funding, and in some cases they even shut down. So you have seen the whole story. So.
Right.
What is your current thoughts on funding? Like, why will you take or not take funding in a business?
So funding, there is a business aspect to funding, there is a legal aspect to funding, and if you are a startup entrepreneur, I think there is a personal aspect to funding. So business aspect to funding is, well, if you've got a model that only needs money to hire or scale technology, and it can scale, like where money can be the big multiplier for your business in terms of growth in customers or growth in revenues, at that time raising money really helps. Growth in customers plus growth in revenues. Growth in free customers will not usually be useful. But yeah, however, if you have a model which requires a lot of fine tuning, and money is just raising money is not the answer, a lot of other aspects of the business, how the business works, the processes, operations, those need sorting out. Then I think, and we must not mistake that to mean that if we raise money, these problems will be sorted. Okay, or if we raise money, our marketing budget will be sorted and we will have higher conversions. A lot of times non-money problems, non-finance related problems are assumed to be key. If I had venture funding, I'd have had a better day, but that is not the case. Secondly, there is the personal aspect of it, is that entrepreneurship is your career, and it neatly blends in with your personal life. There is a very fine distinction, and which keeps on dismantling itself between your work life and your personal life. Now, when you are running your own business, you are responsible for the growth and managing your personal and professional life. But when you have someone else's money on your back, I think the whole equation turns around. Like, your first obligation is, of course, to your customers and to your investors. Okay, like you come last, and when someone has invested your money, they have enough protections that if their money goes down, you might go down in a little. Like, you might also go down, or at least the venture will go down, right? So there won't be situations where the investor is having a bad day, but your venture is succeeding. So in that way, your responsibility on the whole increases manifold. Okay, and that is the scary part of funding. And someone who's raised a big, who's grown a company from startup to being listed, and also raised venture funding, said that when he raised venture capital, his investor told him the first day after funding, after the money was put in, the investor told him that, listen, we've given you our money. Now you need to give your life to this business. Okay. Now, from an armchair point of view, that can be like, yeah, obviously, if I have someone's money, I can do anything. But I think it's a scary thought when you're at the receiving end of it. It's like a Damocles sword, I feel. Yeah. And then there is the legal aspect, which is a different case. Yeah.
So, what what you said is that there are most of the time people assume wrongly that funding will solve the problems of a startup. Like you take funding and you're sorted, right? But
Right.
that's really true. And most of the problem starts after you get funding. And the reality is that if you have not figured out how your business is going to grow, how you're going to make money, then putting a lot of money into that business is probably going to complicate things. In fact, you might be spending too much effort chasing after the wrong things because you have money that cushions you from the realities.
Right.
But if you are at the same time, the reality is that if you're, let's say, going to start a business which is very capital intensive, like
Right.
for example, a major part of your work is basically to set up a huge chain of logistics, right? Because
Right.
logistics is a game. So you set up a huge logistics, and that enables you to succeed in a business. I think
Right.
that's a very different scenario. You need money over there.
Correct.
We have seen like companies like Oyo and quite a few others where basically their job was that they went and acquired properties after properties and made sure that they had the Oyo board outside, and literally they had a lot of hotels, like thousands of hotels literally are like suddenly under banner. I mean, that added a certain kind of value, like people came to expect a certain service, certain standard. And there are startups like that, but I think that these startups are really few in number. We have seen huge failures also in the last five
Yeah.
six years in India, where people raised a lot of money and had nothing to show for it. And I can talk about, even like, I think even in the legal education industry, we have competitors who have raised a lot of money, and
Right.
I think for that money they don't have those results to show. And while
Mhm.
we have not raised money, we had, so there were times our competitor have raised money, so we could not advertise because all advertisement space was taken up. We
Right.
could bid for like a Google ad or Facebook ad because it was so costly, because these guys were driving up the prices.
Right.
And so because we could not advertise, then we were like, okay, now we need to find another way to survive. And we had to go and figure out those new other marketing channels. Like, we went and built our blog, for example. We went and built like, better marketing funnels, or we figured out new ways of finding maybe content marketing. We had to figure out, even to, because we had a much lesser budget and we had to compete. And I think that has been like the mother of all innovation in our company, because we didn't have money, we had to survive. We figured out some frugal way of doing things, some
Right.
more efficient way of doing things. And every time this happens in our company, we, like, whenever we are under pressure, we come up with something which we did not have before. And I think that's what pushes forward a company, a business, a startup, a law firm, whatever it is. Like, those crunches are what shows what you're made of, and also forces you to innovate, forces you to become more efficient. Every time company we have gone through crunches, literally we have become more efficient. Like a lot of people who might have just survived in the organization because we didn't have the heart to tell them to go, or maybe we're hoping that someday they'll perform. But when push came to shove, they just had to be asked to leave because it was a crunch situation, and even they might have left themselves in some cases. Uh, I think these have really worked. This is what. Uh, Now imagine we had a lot of money that cushioned ourselves. We'll spend the money in retaining these people. We'll spend the money maybe doing something that doesn't work. But when you don't have money, you are forced to quickly find out something that works, or you're going down. You're desperate. You figure out something, right? The flip side of this is that sometimes you do go down. Like if you don't have money at all, you do go down, right? So there's sometimes like it just goes out of your hand. You can't manage this, and having that money in the bank at least buys you time to figure things out.
Right. So I have some comments on this, Ramanuj, and some inputs to take this conversation forward. So necessity is the mother of invention, right? And when you don't have money and you need to do something to survive, you get creative and innovative with the process. Now, on the other hand, look at the Oyo Rooms model. What do they need? They need an app, they need a place, they need somebody to go to all the places where there are properties which are capable of being let out. The problem they are solving is the accessibility of a property on your phone or on your web on your desktop from any location. Okay, so if I want to search a hotel anywhere in India, I can look that up. I can find a hotel through Oyo. Now, for individuals who own these hotels, it's a great marketing advantage. But a lot of the infrastructure, barring the marketing part of it, a lot of the infrastructure that is required, it already exists. Like nobody is constructing an Oyo from brick and mortar. There are individuals who decide that I want to build a hotel, or I already have a hotel. Let me give this to Oyo. Or Oyo will approach you and say that you own this property. Listen, why don't we have an agreement? We will, you brand this as Oyo. We will give you this much amount of fees, and you will follow certain processes. So what Oyo does is uses tech to actually aggregate all of this, optimizes it for customers for discovery, so that customers can discover the right hotel at the right price, and give some better technical customer support. Like whenever you book a room, you have a guest experience manager and all of that, and you have a good customer support like you would have in a tech startup. Okay, that is what Oyo does. Now, a lot of the infrastructure is already there, which Oyo needs to aggregate and improve customer experience. So that is a model where you can have funding and grow. On the other hand, a lot of times in education, but people have invested in education, some people have grown, some people have gone bust. But a lot of times with legal education, we've seen that the entire economy surrounding peripheral economy is not constructed. We don't have neighboring systems to use or borrow from. Oyo has at least hotel owners. It has properties which it can aggregate and list. We don't have a way to aggregate education. I'm not sure. I don't think if we just aggregate the current sources of information available, that will result in any meaningful education. You can't just get teachers online to teach and expect that will deliver jobs to people who want to study. So that's why this process gets very fluid, and we innovate every other day. We are innovating and figuring out new ways to do things, because the same model just never works. Okay, so I think that is one of the differences that are there here.
So that's I think.
Yeah, one more thing I wanted to say here, Ramanuj, is that while funding from an investor may not be the best idea, in a lot of cases, if you've got a good pilot and you have some trusted customers, you can try crowdfunding, product-based crowdfunding, where you take money from your customers only, and you say that you will give them 2 times or 3 times the amount of products. You will basically give them money, products at a discount. Pebble ran a huge Kickstarter campaign earlier, and many companies do that. We've also run a small crowdfunding campaign last year. So that is one of the innovative ways of raising funding, where you are very clear. One alignment is that the customer wants maximum value. He's the one paying you for your crowdfunding also. In case of an investment, it's a different thing. The customer needs great services and products, but the investor needs maximum money out. So he wants maximum profits. Okay, so there you have to serve the customer and you have to make a big profit. So these are can be two potentially competing motives. But when you are actually seeking crowdfunding, you are clear. You need money to invest in building a product, and you have to give a great product, because that's what you want the money for. So I think there's a better alignment here of motives when you're taking crowdfunding from customers.
Agreed. I mean, yeah, in a way, like, when you're taking it from if customers are ready to pay you for something, I think it's a fantastic thing, because there's already validation in the market. You already have customers before you've made the product. I think that is like a really powerful concept.
Yeah. But then for customers to be able to trust you, we need something. You need an initial base of customers or a pilot set of customers. These early adopters you must already have. So
let's have a community. Maybe let's say you are a blog and you have 5 lakh people reading your blog, and then you decide, okay, now I want to launch this new product, and then you can say, hey, give this crowdfunding. Right. But if you have a base, I think you can't really do a crowdfunding without anything, or you have to go and personally reach out to people one by one and convince them to give you money, which is
Yeah.
a tough thing, I think.
Yeah.
But yeah, entrepreneurship is not easy. You have to go do difficult things. Yeah. So what about debt funding? Have you thought about it? Like, why not just take a loan? So if you know that there's a clear business plan, you're going to make a certain amount of money, you just need initial capital. How about just taking a loan? I mean, I think there are a lot of venture debt companies currently,
Right.
and there are a lot of banks also willing to give loans. In fact,
Correct.
you get a mudra loan of 10 lakhs, I think, or 5 lakhs, I'm not sure. But basically, government loans which are very given on reasonable terms for very
Yeah,
small.
government has some schemes for SMEs to take loans, and actually loans are a great idea because the cost of a loan is lesser. Like you have a fixed rate of interest that you will give. You're not giving away control in any way which compares to what you give to a venture capital investor. Okay, the protective covenants that a lender has are way lesser than what an investor gets. An investor has a veto over different kinds of major business decisions, which a lender doesn't have. And people prefer doing this. Many banks have, so loans can be secured or unsecured. It is very difficult to get unsecured loans, but these are starting now. So you can get an unsecured term loan, or you can get an overdraft facility. Okay, which is, overdrafts are really good for a startup because you are charged, it's a limit you have, and when your balance goes below zero, you have, like, let's say 5 lakhs of limit, and you will be charged an interest only for the amount that you have drawn and only for the days that you have drawn it. Okay, as opposed to a normal term loan where you take a loan and you have to pay interest for the entire period of the loan. Then it is up to you to spend and use the loan the way you want.
Right.
In fact, because of the security that debt offers, security not in terms of having secured assets, security in the sense that I have a fixed amount of income that is due to come to me. Many venture capital funds have started using venture debt structures, okay, where they invest through NCDs or something, where you will be obliged to pay the money back because that makes sense for them. They take an NBFC registration and do that. That kind of thing is happening a lot more now.
Right. But I think a lot of people are apprehensive of taking a date because
Yeah.
they think that they'll have to pay it back with interest, and it's a big problem.
Right.
What do you think about it? I mean, is that a valid way of thinking? If you know your business is going to work, if it's a different thing if you don't have a plan and you're just trying to take somebody else's money to burn to find out, that's a different thing. But if you know your business is working and how it's going to work, like good example is SaaS companies, right? So somebody has a revenue of $10,000 per month, maybe, okay, and they need a lot of push, lot of sales and marketing push. So they need, say, they need $1 million. And do you think that they should uh, go raise some venture debt or get a term loan instead of going for trying to raise equity investment? What do you think?
No, so some of the venture debt company, some of the SaaS companies we know which have been Calcutta based, there the founders have personally done a lot of marketing and built clients in their target markets, which means again that it's a big relationship building exercise. Something we even hear about Infosys, like where Narayan Murthy would personally go and build his clients. Okay, so that kind of a thing would require funds for what? Your accommodation and your travel. Other than that, you don't need your marketing push will not convert a B2B client. It can be good for customers, but individual SaaS companies don't always want individual. If they are creating, let's say, if they are service-based companies, they will not. But you have an app like a learning management system, then you will need to have a marketing push. For those kinds of exercises, you can take venture capital or venture debt. But there is this approach, that if I take somebody else's capital, I am burning his capital and not mine, which is what scares people from taking debt, because debt, so I have to return. But when it's capital, I don't have to return. But I think that is the reason why many people don't end up getting the capital also, because they have that approach that, his money is not mine. And when you can trust yourself enough to return somebody's debt, that is a time probably you will also be likely to get more people interested in you as investors. And then you can choose what do you want. because ultimately you have to treat it like your own money, and you've got to be able to trust that you have to be able to trust your own managerial and operational wisdom that I will generate more money and profits from this. And that is your faith in yourself and your abilities. Once you have that, I think then equity or debt, you will be able to decide what to do. You may not want to give the kind of upside that an investor wants. And you may have a vision that, I want to grow this from here to here. So if you can do it with debt, then you'll prefer debt.
So there's a huge problem with taking equity is that there is something, liquidation preferences and all, right? Sometimes
Right.
when you actually sell the company or you make money while listing the company, whatever,
Right.
basically you get very less money and the investor takes many times more. Can you explain this concept? How does it work?
Right. So if you take investment, basically whether the investment works or whether it doesn't work, the investor always wins. Okay, you may or may not win. Okay, and if everything goes down, then if investor goes down, everything is going to go down, like your company and your own finances, all of it. Okay, so these are the fundamental ground rules. Now there are many instances where if you breach your investment agreement terms, the investor's rights will kick in, where the investor will want money back at their own internal rate of return, okay, and where you are obliged to pay it back. A liquidation preference kicks in at the time of what is a liquidation event, but this has nothing to do with the actual liquidation scenario of a company. Like we say, a company is in a liquidation when its assets are insufficient to pay off its debts, so its assets need to be sold off, and and money needs to be realized to pay off its creditors. However, in an investment situation, a liquidation event could be defined as anything where where the shares of the company are being sold, where the investor is exiting, where the founder is exiting. It could be any of these events. Basically, in exit situations, what happens is that the investor will say, I want a minimum of X amount of return. Okay. And you would say that, let's say an investor has 15% shares uh, and this is equity, pure equity. And founder has, so investor has 15 and founder has, let's say investor has 25, founder has 75. So founder, if he exits, should get 3 times that of the investor. Both are equity shares, right? And founder has 3 times that of investor shares. But the liquidation preference might make it such that the investor says, I want 3 times my money back. Okay. Now that means that when the founder gets his 3 times more money, first he has to pass it on to the investor contractually. This is all by way of contract. Until the investor has got 3 times that of his own money. And founder may in the process maybe get 1.3 or 1.4 times of his own capital. So investor gains much more, founder gains comparatively lesser. And this gets locked in when at the time you entered into the investment agreement, this got determined. Okay. That's how it works.
So if you do take investment, what kind of liquidation preference will you agree to and what will you not agree to?
I would not agree to anything other than 1x. Their capital with maybe a certain amount of return you can agree to. Like, but investors demand 20% return, internal rate of return year on year, and that is crazy. Those kind of amounts. And this happened in this the Ranbaxy Daiichi Sankyo exit, which went into international arbitration because the RBI stepped in and said that we can't allow payment of the internal rate of return, because if anything more than the fair market value is paid, then it amounts to it is not an equity investment anymore and it's a debt. But then India was being taken to investment treaty arbitration for expropriation, and in the middle, but the High Court or the Supreme Court agreed for contractual repayment of the amount, and then the case was sorted. But yeah, so
saying that the High Court or Supreme Court decided,
they accepted the payment of on the basis of the internal rate of return, and they said it's fine. Like they did not. RBI intervened and said that this makes it a debt which is inconsistent to India's FDI policy. But the High Court turned it around. It overturned it.
So Now that we have heard a little bit about debt and also about equity funding, uh, is there a way, like what are the other possible ways that one could fund their company apart from debt, equity, and crowdfunding? Uh, in India, obviously, crowdfunding is not equity crowdfunding. It's usually is like pre-orders. Like you're going to sell something and people just pre-order it, and you have a lot of orders, so you can actually use this as a capital and start your business or start a new product line. But is there any other way of funding your company apart from this?
I mean, any other way is basically instruments in the middle of equity and debt, like convertible instruments, CCPs, CCPSs. The other one, which recently the ministry allowed, was the convertible note. So you can always do a convertible note in a domestic scenario, but what got allowed was a convertible note from a foreign investor for certain categories of startups. So a convertible note means that you have not decided you've not decided the valuation of the company and the valuation of your investment, but you just give a certain amount of money to the company at that point in time. And so say a company needs $500,000 and it's got its initial product ready, it's got its proof of concept. To be able to figure out its market valuation, it needs to explore this a little more, monetize and all of that. So initially, let's say it just needs $500,000. So you pay that amount and you say that you will be raising the next amount of fund, say between 6 months to 24 months. Now, depending on when you raise the next round of money, I, as the initial investor of the convertible note, I will get that my investment will convert into equity shares at a discount, okay, to the price that the next investor invests. Okay, now that enables you to skip this exercise of initial valuation. This is done a lot at Y Combinator.
Yeah, Y Combinator, basically all the initial funding happen to.
Yeah.
So
now they've come up with a new one. I have not studied it yet. It's called SAFE, SAFE. We'll be studying it and then talking about it later. But yeah.
So in India, I think convertible note is getting quite popular at angel investment seed round level.
Yes.
These are some of the ways in which you could possibly fund your company. Are there any other ways in which a company could be actually funded or financed?
I can't think of offhand. What, do you have some ideas? I don't think so.
Yeah. So one thing that I can immediately think of is these days people have started launching their cryptocurrencies, right, of a company.
Yeah.
And it was recently shown like a very popular startup series called Silicon Valley. What happened is that it was a huge problem for them to take money from the VC because, they saw that the VCs will just try to maximize monetization and completely sometimes ruin a company so that they can get the money, and they are completely, nonchalant and very mechanical about it. And the founder gets really jittery and he says that, I don't want to take my Series B from the VC anymore because if I bring another, if I take Series B, they get another representation on my board, and practically I am going to lose control of the company, and so what he does is he instead tries and goes to raise some uh, uh, money through cryptocurrencies, and he launches it as a token, like a utility token, and only in the US it shows United States, and in the US things are much more clear in terms of what is allowed and what is not allowed. ACC has clear rules about how to sell, cryptocurrency and utility tokens and all of that. So, but short, long story short is that this company managed to raise a lot of money through its own cryptocurrency, and they went on to that's what they used to fund themselves.
Right.
In India, I think it's very dicey because you will attract public offer, basically you're doing a public offer. If you're offering this kind of, I mean, it's questionable whether it's necessarily a public offer or not, but most probably
Yeah.
some RBI.
The RBI won't call cryptocurrency a security. I mean, SEBI won't call it a security, but RBI has already directed banks not to offer this conversion services of cryptocurrency into Indian currency,
Yeah,
which
that
means
is one part of it. But let's say you start selling your own cryptocurrency, you don't go to the bank, you just give people these tokens in whatever format you can, and they pay you cash also, or they pay you in whichever way. It's possible. Like you're not using an
that is
intermediary.
that you can do because that is a closed wallet. Okay. The problem happens if this currency is tradable between people, then some regulatory issue will be there. But if it's only between those people and you as the issuer, then it's like a normal closed loop wallet.
It will be tradable, even if it is like either it is a cryptocurrency or whether it is a utility token. You can always sell it to somebody else, right? And because let's say you say that.
Yeah, so you get a PVR coupon, you can give it to somebody else.
Yeah, exactly. It's a coupon, right? You say that using this coupon, you can watch a movie. So,
Yeah.
or you say that, using this coupon, you can watch one webinar. Or you can log into a course which is worth 5,000 rupees. Now, this coupon can get traded. Like people can give it to
Trade it
another.
on an exchange.
Sorry?
They can trade it on an exchange, they can trade it privately, all of that.
Yeah, absolutely. You can't stop that.
Yeah.
Now, what happens is that, or you can stop that. Maybe you don't want to stop it because you want it to be of some value.
Yeah,
Now,
no one will want to stop it, ideally. It increases, if you're a startup, it just increases the kind of faith and liquidity that is there for your products.
yeah, absolutely. But I think it will attract open. Basically, you're doing an public issue of security, the Indian Securities Law, other Companies Act also. It's a public offer, and it's something which is very dangerous. Can land the founders into big problems. So absolutely not recommended. But obviously, a company could look at setting up entity in a different country where this is legal, and they could want to offer this kind of a, they could do a sell, token sell. And I think it's possible to do it in Singapore, Japan, and Canada. Tradition, Dubai also. Like these are places where Indian entrepreneurs are comfortable with, and they frequently visit. And I think this is emerging as an option. People have even started doing this in some cases. But doing this sitting in India is probably not the smartest thing.
Right.
But do you think that Indian government is at some point going to allow this? This is $1 million question because it seems the government is very interested in blockchain technologies to be used. But
I think they may allow after they study it a bit, then they may allow within certain limits.
You're saying they might allow when?
They might allow after they study it a bit, and they will pass regulations on it and then allow it. I think it is possible.
So interestingly, we have been bullish about blockchain technology.
Sorry?
Now, blockchain technology cannot function without cryptocurrency. The idea of blockchain is that there are people who are, there's a third, it's called like there's a third party accounting system which is going on, which is what the mining rigs are basically keeping track of.
Right.
And the entire idea fails if those people are not rewarded. The people who are mining, who are basically keeping all this system running, if they are not paid, like they are using computers, they are using electricity, they are using air conditioning systems, like to keep this running. And if they're not rewarded, then why the entire system collapses? Like the blockchain doesn't work. A public blockchain cannot exist without miners, and the miners getting rewarded. And the miners get rewarded through cryptocurrency, which is why this whole idea was there.
Right.
The government of India is not going to allow any cryptocurrency exchanges or it to be exist and it to be functioning.
You are saying they will not allow because?
So far they haven't. So far they have completely blocked it, and now
is there a reason you think they may not allow even after 2-3 years? Like there's a
Supreme Court case going on.
People
have objected and brought up constitutional grounds, saying that you have a right to trade and we have a right to property and all of that. That these are assets that we have. We are reducing the value of our assets by taking arbitrary action and all of that.
Right.
But in the end of the day, the problem is that these are getting used to fund companies which are actually not listed. So this is a way to bypass the entire SEBI mechanism, entire the stock exchange mechanism, right? So you
Right.
can just start your own company and float your own cryptocurrency, get money from the public. And how long will it take before people start duping, the poor people in India? And
Yeah, which is why I think they will close those ends first, and then only they will allow if they do.
correct. So there has to be it has to be really regulated where,
Correct.
but who knows? The whole idea, the reason some of the cryptocurrencies really succeeded is somebody comes up with something and, sort of like investors start investing and the news spreads. But if the government has to decide who can launch a cryptocurrency, I think it's going to be quite sad.
Yeah, the whole philosophy of it fails. The idea was not to have a central bank.
Not to have a
the last mile, because the central bank is enabling you to invest cash into it, they have started regulating it like that.
So, to be honest, even now there's P2P, basically trading is possible, right? So what is P2P trading? This is even legal in China. Not that it is specifically legal, but it is happening. Okay. So China has banned most of cryptocurrency trading, cryptocurrency exchanges and everything. Chinese exchanges, like for example, Binance, which actually posted a bigger profit than Deutsche Bank in the last financial year. They had to shift to Tokyo because China cracked down on cryptocurrency exchanges within mainland China. Now, what happens is that even now there's a thriving market, not maybe as much as before, but there's a thriving market of cryptocurrencies. How it operates is to P2P. So you can find somebody online from whom you can buy or sell a Bitcoin or Ethereum or whatever. And after you find them, you just go meet the person, they give you cash and you transfer the coin to them.
That's a Hawala. Cryptocurrency Hawala.
So, Abhyuday, we are not getting your video. Have you switched off your video by any chance?
No, it's on. My video is on.
Okay, let it be. It's fine. Whatever it is, there's some problem. We don't know what it is. There's apparently some video feed is not showing up on the screen.
My video is showing you. Can you see me?
Is it better, Abhyuday? Can you hear me?
I can hear you. I can see you also. Can you see me?
I can see. I had to just change the internet connection. Now this is working.
Okay.
So, yeah. So basically, I was just saying that in India also the situation is such that there is no law which actually prevents you from buying or selling or trading cryptocurrencies.
Correct.
Just that it will have to happen through a P2P channel because banks will not allow you.
Yes.
So
you need a BitTorrent for this.
Correct. So if you want to now buy a Bitcoin, you probably have to find somebody who has a Bitcoin, and there are a lot of internet forums and systems to do that.
Yeah.
And then you have to meet that guy and take his Bitcoin and pay him in cash.
Yeah.
That's pretty much how it now works.
Got it.
So I think there is no real way of funding an Indian company through this channel right now, unless you are willing to shift to another country.
Mm-hmm.
At least have an entity in another country which can raise finance there through this method. And then you have to look at the laws and regulations in that country. It may not allow you to function from India while you just run an entity there to raise some cash. So that's also an issue. So what are the other important questions about funding according to you?
Other important questions are sources of funding when you start out. So you can raise funding at various levels, but so right from angel funding, venture capital to private equity. But I think the most important part to figure out is the first time, right? After you do it the first time, I think it gets easier to do it the second time because you also have your investors with you who will be supporting you in follow-on round of investment. And
you have done some performance after taking the money. After taking the money, you can't show any progress, then I think it's quite hopeless.
Then it's clear. No, then you're not going to do it. You can't do it anymore. But so the part that needs to be discussed a lot is the start of it. And to begin with, then you can take. So we didn't discuss money from friends, family, and fools. It is angel investment, and but yeah, it's like it is taken as equity. A lot of times that people take this money, when people take this money, the thing is it goes unaccounted for because your startup does not have a proper accounting and bookkeeping system. So it is shown as money in the bank which gets spent, but in your accounts it is not clear whether it was debt, how it needs to be repaid, or whether it is an equity investment. When an investor comes in, he's going to want a clean cap table, which means one of two things. Which means two things. One is that it should be clear who has what equity in your company and what the liabilities of your company are. The financial position should be clear. Second, obviously, that there are not too many people eating up equity at that stage in your company, because otherwise governing it and running it will be a problem.
Okay. So, should you take money from any investor who's ready to fund you, or should you be a little careful about who you take money from?
Yeah, so there are lots of different kinds of investors. 1 second. Some could be professional investors, who are who excel at investing, giving a financial investment. There could be others who've been serial entrepreneurs earlier and who can add a lot of value to your business. In some cases, the serial entrepreneur may have been involved in the same industry that you are in. I think those are the best kind of people to invest, because there will be a fit in terms of you not only get their money, but their support and their insights on that market and from their journey, which means that they will also understand an entrepreneur's mindset, as opposed to someone who's been a person with a financial investor background. He's going to focus that much more on the returns and specifics of what's your plan, how are you getting there, but not so much on the human side of supporting you and connecting and giving you insights on the market. That
right.
You could also take an investment from a strategic investment from somebody who's already operating in that business and wants to. It's like an acquisition, but they won't acquire you. They will invest in you so that you grow. And there may be some kind of a long-term synergy they see, which is why they're investing in you right now.
But don't you think that can also lead to some problems like conflict of interest? Somebody having a strategic interest in you will, may not want you to succeed, or there may be issues, don't you think?
Yeah, before you take your investment, you need to figure that out. That is this going to be? Is your venture going to be killed, or will it be competing with something else, or is this entity only interested in covering different verticals or aspects of the business, and is therefore it is investing in you so that it gets a wider foothold in a bigger industry segment? So what the motives of the investment are, that needs to be figured out.
Okay. So we have got a bunch of questions. We might as well start answering them now.
Yes.
So Venkateshwaran is asking, how come large investments are made in spite of a startup like e-com companies making losses for years? What did you say to that?
How come large investments are made despite companies making losses?
They like, say for example Flipkart. They got like some $3-4 billion of investment, right? Despite not making profit till today.
Right. So in the case of Flipkart, we have a longer history of Amazon having made profits after 13 years. Okay, and people have a long-term view that whether that this market is eventually going to turn out to be profitable, and they may not know exactly how. Like Amazon started making a lot of money from its web services and digital segment. Okay, and it made losses on its e-commerce segment. But the faith is there that in the long term, the entity that grabs the market is going to make a profit eventually. Okay. Now, so how long a term is the investor going to play? How long a game?
I think not only a profit, there's a huge profit they stand to make if they're able to capture the market, and that is what they're doing, right?
Correct. And now the thing is that in that case, then why are successive rounds of investment happening? So from one round to another, they are going to measure that what is your market penetration, what are your revenues. So in each of these cases, you will notice that the company's balance sheet has grown. Means its turnover and sales and users have all grown. The only thing that is
Categories have come up, maybe new categories of products that they
new
have.
product lines have come up. Costs have also increased for that. But then when you notice that the market is increasing and expanding, the market share of the company is expanding, it's penetrating new markets, then it inspires that broader confidence that yes, this is going to be profitable in the long run.
For many of these companies, I think initial years they invested heavily into logistics. That was a big factor, right? Like there was no reliable logistics for them that they could simply go and use.
Yes.
To literally create their own courier and delivery companies.
Correct.
Even a lot of other companies in the e-commerce space or delivery space, they are doing this. Like their biggest job is to create an infrastructure of delivery boys with bikes and stuff like that. And rather than it's not like they're really in the business of making apps or making online websites or something like that. Their real job is to create an infrastructure, and obviously these are businesses which require really heavy investments.
Yeah. So I think I'd read that in how Amazon does it is in US, during certain months of the year, it will have people who are on mobile trucks, and their truck is used as an Amazon warehouse. And basically they travel different parts of US. They will sleep in their truck only. And anytime deliveries are made to those areas, it will go out from that truck. So there are innovative models around logistics that these people make.
So we have another question. Somebody's asking, Mona is asking, what is angel investment? What is the concept?
So angel investment is investment by at the first stage when at the initial stage of your startup, you get investment from someone who believes in your business plan and in your vision. They invest. So they are like angels for you. That's where the concept has come from. And usually angel investors invest their own money, although it can also be a pool. It can be a pooled fund, but in a lot of cases they invest their own money. And usually in India, how it operates is that angel investors form a network. They don't create a fund. They form a network through which they invest their. So this network will source opportunities, vet opportunities, hear pitches together. Then one or more investors will personally, if they are interested, they will invest in the startup, and they may do this together in the sense that they'll two of them may come and invest their own money, and they sometimes rely on each other's business decisions because they've known each other before or worked as associates, so they trust one person's market sentiment.
Okay. And what are then seed investments? Like, what is the difference between a seed investment and angel investment?
It's more of a technical parlance, but after angel round, the next is the seed funding round. No, I think it's the same. I think I don't remember. Like there's a fine distinction, but both are in the earliest stages.
Seed happens the earliest. Angel investment happens sometimes.
And seed is after that, right?
Seed investment is the first investment. Like it's just the first thing. Like just to get things going.
Yeah. So your angel round may be the seed round, or sometimes you may have some angel investor, but later on do a seed round, where but the next one that comes is a venture capital round. Series A venture capital. That's the key thing. Now these are commercial terms, but what you need to look at are the terms of the instruments and what are the terms of investment, what are the rights of the investor, what is the return he wants. That's what you need to look at. Okay.
Another question we got is that what are the advantages of bootstrapping a company rather than taking any funding at all?
There are lots of advantages. You get to run the company the way you want to. You get to make your own mistakes. That's a disadvantage also, and an advantage. The biggest advantage is that you get to value money. You are able to understand cost, revenue, profit at a unit level much better when you do bootstrapping. One of the flip sides of that is that you may not be able to play much longer term games because you will not have the funds for that. So you will want that I want to have profit on a month-on-month basis, or you may not be able to take on initiatives which turn profitable say after 6 or 7 months. You may want, okay, 2 महीने में profitable होना चाहिए. So that can be a disadvantage and an advantage that you understand the value of money better. Whatever you launch turns profitable the moment you launch it. That's how sharp your ideas will become. So that's an advantage.
Yeah, I think the biggest advantage of bootstrapping is that you are left to yourself to figure out how to survive, and you're left with all the equity also. Like nobody is asking for a piece of your success, but all the failure is yours alone to bear. But actually, that is how it is anyway. Even if you take funding, it is usually like that.
Yeah, I think when you take funding, all the failure is yours to bear, but you are at the edge of a tank, like you are being shot by a tank.
So, as far as funding is concerned, I think being able to fund yourself, which is through bootstrapping, like a business organically grows, is probably one of the best ways to grow. And that is how historically probably 99% of the companies and businesses in the world have grown. As a matter of fact, there are only maybe 1% companies which have been inorganically grown through a lot of funding. But that's like the exception rather than the rule. So somebody who's starting a bootstrap company should not feel left alone or bad, because that's pretty much the way to create something valuable.
So I think this is a very important point, because any business can be fundable and can grow on its own. The funding aspect increased a lot when technology startups grew, because technology could scale with money. That was the idea. And that's where funding became the supreme element of potential startup success. But if you have a good business, I think that's what counts. Have a good, profitable business that's growing and that's rewarding all its stakeholders. That is what makes a difference.
Right. So, what are your thoughts on this? One more question you got is that how do you go about looking for investors? From Venkatesh Ramanuj.
That is really challenging. You have to go. I think Ramanuj will answer this better.
So, with a caveat that I have never raised funding, but we have several times got promises that people were willing to invest in us, and we did not pursue it any further because we are not sure that we should take the funding at that point of time. And for the same simple reason that we didn't have, I believe that you should take funding when you have really clear plans as to what you are going to exactly do with that money, and you know that this money is going to be a real multiplier, like Abhyuday was saying. Like, you know for sure that you're not trying to solve other problems with money. It's like really a money problem that you're doing well, but to grow even faster, if you put in a lot of money, the growth speed will actually increase. Until the time you are sure about that, you probably should not raise money, especially if you have a good business which is generating profits, which is generating revenue and generating value. You got to protect, like, you have to figure out a model where, yeah, this is working, this is going to work for the next 10 years. I just need money to pump into this so that it grows 10 times or 100 times or 1,000 times.
So for your first round of funding, you may want to say you can be with an accelerator or an incubator, but then they will invest something and they will take an initial stake of 8, 10, 12%. But that will give you their investment will be much lesser that way. But that will give you an access because they have connections everywhere. And if you're a promising startup, can actually.
Of course. Like, the first thing is that once I really don't believe that tech startups today have enough cost so that they just need to go and start raising seed funds and take money from accelerators somehow for the 6 months. I think that's like a recipe for disaster. Rather, you should figure out, make a decent product, figure out how to sell it. Most products, you don't need to make like a crazy, insane product that is going to be like, used by 5,000 people like on day one. Like, you need to build a product that maybe, 10 people are willing to use, or maybe 5 people are willing to use, or like, 100 people are willing to use. And that's the thing, I think, like really something to figure out. Once that is figured out and you have revenue, the reason that investors will get interested in investing in us is because we have revenue. Over the years, there's a track record of making money. There's clear growth in the revenues. So that makes an investor want to invest, right? But If you don't have that and you just want money because you're starting a great company, what makes it great? You have to show that, you have revenue, you have a product which is working, which is well received in the market. That is when you get funded. Like, I know there's this fairy tales about, oh, my friend had nothing, they just had an idea and somebody gave them $1 million to start something. That is like a fairy tale in the end of the day. Yeah, sometimes people got it, but there's no formula that anybody knows of how to get that. And it is not probably a good idea. You should check 5 years down the line how those companies end up. Uh, what is probably smarter is that instead of looking for investor, build something that you'll invest in. Like, it should become a good business that your dad will say, why are you going to investors? This is such a good thing. Give it to me. I want to invest. That's the kind of business. You are so clear that you have built something which is so valuable that you need money, yes, but anybody will be happy to invest because it is so good. And I think there is opportunity to work like that. And that is what we need to think. Somewhere, a whole generation of Indian entrepreneurs have bought into the fairy tale that, you just start something, 3, 4 of us come together, we go pitch to some events and to some people and they'll give us money. I think that's really not what it is, like, I know that
So
work.
also, whoever is judging you, and if they've been investors, they'll ask you that, what is your traction? How much are people paying for it? All of that. So if you've not tried and tested things out, nobody will fund you.
Yeah, it's very difficult. Like, it's some people do get funding. I don't know. Like, sometimes it's like the VC have a clear plan that, what happens actually. You are unlikely to fit into something like that. So the VC decides that this year we are going to fund one company which is going to work on a social media in Hindi language. Okay, they decided it. Now they will go find a team or they will try to see somebody who's already working on it, and they'll say, listen, we're going to give you $100 million. You have to make the biggest, Hindi, whatever, right? In the next 3 years, we'll give you $100 million. Here is your first 2 million, make something, then we'll give you more and more and more. Now, when this has happened in several industries, Tiger Global was known for doing this. They'll say that this worked in China, this has to work in India. So let's find the company which will do this in India and most likely to succeed. And then all other VCs will also find their own candidate in the same category and fund somebody. So that way, many people have got funded even when they had no product, no profits, no revenue, no employees. They got funded, yes. But maybe things that counted over there was, who do they know? Do they know the VC? Do the VC already know them? Have they worked in something before together? Maybe they're in college together. Maybe they trust each other. You don't know. Maybe they have family relationships. You don't know like how it got funded. Now there is no predictable way of cracking into this kind of theories. Either you have to know somebody in those funds and they clearly say, this year we are going to invest $30 million in legal tech for sure. Now you just go and build something in legal tech, something which is or they say this is our investment thesis for legal tech. Somebody who does this will invest in it. Now, if you can find something like that well and good, but it's highly unlikely. What works most of the time for a normal entrepreneur is that you build something, start showing results, then people will come and invest. At least that is how it works in India. And I think it's fair way to work. Like, you should not be expecting, hey, I will make a PPT and some spreadsheets and people will give me a lot of money. And then I'll figure out how to build my business. That's like, that's really stupid, to be honest.
Right.
And how to find investors when you have built a business? There are ample ways. People will even find you themselves. You can go to mentors. There are a lot of people out there. There are organizations like TIE, Startup Saturday, Head Start, this, that. Many of them are there. There's Let's Venture. A lot of people are there. You just have to, reach out to the right people. Tell them, look, these are the results, and they'll give you a meeting. If you say that, hey, I am doing 1 crore revenue a year, or you say, hello, I have 1 lakh active users per week or something, everybody will like to talk to you. And that's something you have to figure out what you're going to build that people at least say, okay, I want to hear what you have to say.
Right. Okay, Ramanuj. 9 o'clock. What do we do?
9 o'clock. Let me see if there's any other question on this, or we'll wrap this up. No, we actually don't have any other questions. I think we can wrap this up. So, okay. Thank you, Abhyuday, for coming.
Thanks, Ramanuj. Thank you, everyone.
It was great talking. Take care. Bye. Bye, everyone.
Bye.
We're
See you.
signing off, and we have an exciting bunch of people lined up for the next of the week as well as for the rest of the month. We look forward to having you every day, every weekday actually, between 8 to 9 p.m. We have an hour with LawSikho, and we hope to see you again soon. Take care. Bye.
Bye. Cheers.